With goldsilverpros.com. In the following interview, I speak with Nick Barisheff, CEO of BMG Group in Canada. Nick recently published a research report called The Illusions of Owning Gold on the risks of owning ETFs in your portfolio, and we specifically discussed the risks of owning the GLD and SLV. Stay tuned for the interview. So I was reading through your article, The Illusion of Owning Gold, and it's a pretty interesting article. I learned a lot about ETFs in general, which surprised me, and specifically about the GLD and SLV. So I wanted to know if you wanted to talk through that document, because I think it has a lot of good information for people who are interested in investing in gold and silver.
Right, and there's a lot of confusion and misconception, and that many people think that ETFs are just like open-end mutual funds, but with low management fees. But they're nothing remotely similar.
Yeah, so why don't we jump into it right there. One of the big topics of the article is how ETFs don't have to follow all the financial regulations of a mutual fund, for example. Can you discuss a little bit about how that works, how it's different for ETFs?
Well, in the case of a mutual fund, particularly in Canada, and it would be worse in the States, is that there's a specifically described format of what a prospectus must contain. So that doesn't apply to ETFs for some reason. It's too complicated to get into the underlying reasons, but they operate with a registration system, which still technically means truthful and plain disclosure, but it isn't in any prescribed manner on what it should contain and shouldn't contain. Mm-hmm. And that's why in the first GLD document, I think it was about 140 pages, and then next year when they renewed it, it was 70. And so the current documents are that short. Now, in my case, there's no chance I could leave out half of the prospectus and have the securities commissions approve it. So that's a big difference right there.
Okay. And you quoted something that Catherine Austin Fitts wrote. She's President Solari, I believe the former Assistant Director of Housing and Urban Development in the United States. And I wanted to read something that you quoted from her documentation. ETFs use a registration statement instead of a prospectus, and as a result are not subject to the same regulations as open-ended mutual fund trusts. And according to a report written by Catherine Austin Fitts, the term exchange-traded fund is not a precise legal term defined by statute, as is an investment company, of which mutual funds are a subcategory. And I'm going to continue reading here. It says, both hedge funds and ETFs, at least under current law, are investment vehicles created for the express purpose of avoiding some or all the regulation under securities laws that apply to investment companies and traditional stocks. And it goes on to talk about some of those things. So it seems as though ETF is more of a tracking vehicle rather than a specific investment fund that's heavily regulated by the securities commissions in the states. So what are some of the risks of that for people investing?
And people don't notice when they read that the subtlety of the word. When they say it's a tracking vehicle, and it does a reasonably good job of tracking the price of gold on a normal day, but nowhere in the documents does it say it's about owning gold, because you don't own any gold in the ETF. If it's to really understand ETFs, you have to go back to the very early ETFs, which weren't the gold and the silver. They were index ETFs, like say, let's take a Dow ETF. So in the Dow ETF, the authorized participants would assemble baskets of Dow components, the 30 Dow stocks that would form a basket. and contribute those stocks to the ETF. The ETF would issue them shares of the ETF, and they would sell the shares to the public. Now the issue becomes is, where did they get the shares to contribute? Well, if you think that Wall Street is going to buy shares at net asset value or the prevailing price contributed to the ETF at net asset value, get shares at net asset value, and sell those to their clients at net asset value, you're incredibly naive. Wall Street doesn't work that way. Mm-hmm. So the issue is the brokers that are authorized participants have always been able to borrow the stock from their client's margin account. So if you have a margin account, the broker that you have the account with doesn't have to ask your permission to borrow the stock. They just do it. If you're a hedge fund and you have a prime broker, usually you will have an agreement where the prime broker has the right to borrow the stock. So they borrow the stock and they contribute to the ETF, then sell the ETF shares and keep all of the money. Now, when the client that owns the stock, say, wants to sell one of his stocks, then they simply transfer what would be the theoretical proceeds of sale back to the client at the time. But in the meantime, they've had a totally interest-free loan all the time. So that's the way it kind of started. But then when it came to gold and silver ETFs, they have to get the gold and silver from somewhere. So they're certainly not going to the market and buying it at spot price, contributing it to the ETF at net asset value, and then getting shares at net asset value, and then selling those shares at net asset value. So the only way they can get the gold is to borrow it or lease it from the central banks. Okay. Now the thing is that with all leasing, just like when you lease a car, title to the car or title to the gold in this case remains with the lessor, the central bank. So you have an anomaly there that the leased gold is sitting in the ETF, but the bank that lent it in the first place still has a claim. So everything works marvelously unless the authorized participant becomes insolvent. So if the authorized participant becomes insolvent, he can't pay back the lease, so the central bank will go to the ETF and say, here's a copy of our lease agreement, please send our gold back to us.
So they basically have a first claim to the gold in the fund through the participation of the authorized participants, and it's not people buying shares in the fund like the retail market.
Well, that's the point. You see, that the claim to the thing is that title to the gold has never left the central banks. It's theirs in the first place. It's not that they have a first claim. It's their gold.
Yeah.
Just like when if you lease a car, you don't own the car. You just get the right to use it. The lessor still owns the car.
Okay. So let's talk about the custodians, and let's discuss what the custodian is for GLD and SLV, who they are, and what the risks are from the custodian perspective.
Well, there's a lot of other issues there because the entities HSBC, JP Morgan in the case of the SLV, they have tons of lawsuits against them for manipulating the silver prices. So they're hardly the people you want as custodians.
I agree, and I believe that Catherine Austin Fitts, who you quoted in your article, has a book out documenting all the lawsuits against JP Morgan, not only in the precious metals markets, but just in general. And it actually, she just lists links to each of the cases, and it ends up being like a 20-page book of different cases. So JP Morgan certainly has a lot of legal exposure in the markets due to a lot of the people bringing these cases against them. So not really a huge surprise that they've had issues with manipulation claims in the silver market.
Right. But then you get into also like in 2008, Lehman Brothers was an authorized participant, and if they hadn't been bailed out, then it would have caused a collapse in the ETF marketplace, because then the structure and the risks would have been seen, so they covered it up. But now we have, particularly a couple of major banks like HSBC and Deutsche Bank, both of which are authorized participants, and both have seen their stock prices precipitously decline. And many people think that they're on the edge of going over the edge. So we'll see what happens there.
Yeah. This is really eye-opening for me because I just didn't realize the weaknesses of ETF investments versus others, and I don't typically invest in a lot of ETFs now. I think we kind of discussed that on our last conversation, but a lot of people put money into ETFs, and a lot of it's going through retirement accounts, a lot of it goes through the retail market as well, and I don't think that people are really aware of the lack of protections that they have.
That's right. No, and a lot, because, like I say, unless you've read the documents, and in this case, you have to go back and read the original document in 2005. Mm-hmm. And at the time, in Edgar, they also published the authorized participant agreement. But now you can't find the authorized participant agreements, and so on. So that the surprising thing there is that when the authorized participant is contributing a basket of gold to the ETF, what it says is that after I've contributed the basket to you, then you will have a good title. Mm-hmm. And that's kind of a logical non sequitur. A vendor can't tell the purchaser what he will have. He's got a warrant that he has good title, mm-hmm. and it's free and clear from all encumbrances and the usual wording when you convey a hard asset. But that doesn't exist in the authorized participant agreement.
One other thing that you pointed out about the potential of total loss for ETF investors is a situation that occurred in 2011 with MF Global. It says here from your article, investors were interested in acquiring bullion through commodities futures due to the attractive leverage. Instead of making leverage profits, most of the investors lost all the money when MF Global declared bankruptcy in 2011. So is the GLD and SLV basically another version of MF Global? And if we have another financial collapse scenario, could the same thing happen?
The MF Global was an outright fraud. The people's accounts were raided to help support the company. So it was a straight fraud that never really got prosecuted. But in the case of GLD, it's just like I say, that if any authorized participant on any ETF anywhere in the world were to become insolvent, then you're going to have a problem between the lenders of the asset and the ETF shareholders. So they're going to have a fight over who's the real owner.
Mm-hmm. Making the lawyers rich, no doubt, racking up legal fees.
Yeah, there'll be big legal fees on that one.
So I think one of the effects that these ETFs have on the market is it's kind of phantom demand, just much like the futures market is for gold and silver, where people may be putting money into GLD or SLV and not understanding that there's real title to gold being moved into these funds. It's lease gold, so in other words, it's gold already owned. So it may be masking some of the actual real demand on gold that we would see if every transaction were I give you money and you give me the metal. So what effect?
Totally masking it because if the GLD, for example, was actually going to the market and buying the gold rather than borrowing it from central banks, that would be a tremendous increase in demand, and the price would be multiples of what it is today.
Mm. Well,
they're totally distorting the demand by deflecting into borrowed gold rather than buying more gold directly.
Yeah, and I think a lot of this has to do with sort of the institution of financial professionals that exist to take people's money and put them into some sort of passive investment. It seems as though the rise of passive investing has led people not to buying real things, but to buying derivatives in general, and that certainly applies to gold and silver, it appears, through these vehicles. So it doesn't seem to me there's a lot of safety in those vehicles at all.
Right. But you see, with gold, and silver to a lesser extent, they're monetary assets. Mm-hmm. The Bank of International Settlements rates them as zero-risk assets for banks and central banks, so they're the ultimate form of money. And when you do that, you want to actually own the gold. Now, to own the gold or any hard asset, there's some steps to go through. You can't just go on to your online broker account and type in a symbol and bang, you've got it. Whether you buy a car, a boat, a house, there's processes to go through to ensure that you have legal title to the asset.
Yeah, and that's a really good point. I want to talk about real estate for a moment because I'd been a real estate investor for almost 20 years here in Texas area, and we had to buy title insurance on every house, or the seller usually in Texas usually pays for it. But every time there's a transaction, there's title insurance. And what they do, the whole point of title insurance is to have a title company which has records dating back to whenever the land grant here in Texas, whenever the land grant was originally given, and then to track all the warranty deeds or the ownership changes on that land through time so that when you're going to close a transaction, there's no dispute of title. And it's funny that in real estate, this is such a developed process, but when it comes to buying a lot of, financial derivatives, it's really not as well developed. Why do you suppose that is?
Well, it's just people, have gotten complacent and so on. We have the 3 mutual funds, and we also sell, bullion for storage. And we have a number of investors that have over $1 million, and it's a process. It doesn't happen instantaneously. Mm-hmm. We've got to comply with anti-money laundering requirements, and we make sure that when the person invests with us, he gets title to the actual bars that he buys. Mm-hmm. So we go through a lot of documentation to make sure all that happens. So it doesn't happen quickly the way it does if you were to buy the GLD.
That's a good point. It almost seems like the more convenience you have, the more risk there is from a title perspective.
Exactly.
And do you guys also follow, I know we have laws down here in the States called Know Your Customer laws. Do you have to do your homework and research on who's buying your product when they're purchasing it?
Well, in the mutual funds, we have all the securities implication. The bullion bars are not a security, so it's not regulated except for money laundering and terrorist financing issues. Mm-hmm. So we're registrant under FinTrack in Canada, which is your equivalent of FinCEN.
Yes.
But other than that, it's not a security.
So, okay, that's interesting to know. So when somebody's buying it through you, they're getting allocated storage and they're getting serial numbers attributed to their name where they're the only one that owns that bar of gold. Is that correct?
That's right. You need more than the serial number to identify a bar of gold. You need the refiner, the serial number, the exact weight, and the exact purity to 3 decimal places. That's what identifies the actual bar.
Okay. Yeah, that definitely. I'm familiar with that. I've owned gold in foreign jurisdictions and held it at places like Brinks and other common warehouses. And the number one thing that you're taught to look for when you do that is making sure that you own legal title to that and that there's audits performed on the ownership of that, so that it's very clear. And to me, that sounds more like the real estate process where you buy and sell real estate and you have somebody auditing that and they're looking through the county records and they're providing you insurance to the point of if there's ever a dispute, they have to pay out on that dispute. And that's the whole purpose of having the title company.
And that's, because my background is in real estate, I was the manager of the investment division at A. LePage. So when I set up the Bullion Bars program, it took us about 3 years to write the software and have everything handled. I structured it the same way that we have our software is like the registry system. So it's a totally secure system that can't be hacked or anything else. But we also issue physical deeds that are printed by the Canada Banknote Company, so they're deeds that can't be forged or duplicated. So there's 2 records. There's the electronic record with all the backup and so on, and also the physical copy with the deed that each investor gets.
That's a really, really good point. I was doing some research along with Lynette Zhang back in 2018. She works for a precious metals dealer. She had done some research on stock ownership and how that works, and I don't want to get into all the details, but we found that there's basically a fractional reserve system on stock certificates. And, I'll link to this in this article. I did a video on this back, I think it was early 2019, on how if you don't actually own the stock certificate, you don't have direct legal claim to that stock. You're basically a beneficial owner in a trust format. And the market registrants who you purchase it through, and there's a whole chain of ownership. So if you're going online to E-Trade or Schwab or something, they're the first person in it, but there's a line of ownership above you. So there's actually a lot of risk in owning stocks without certificates, and it seems as though that's true of any investment you make. If you don't have the title in your hand, you're not guaranteed that you actually own it. And it really, that's something that I've started to pay more attention to.
Well, that's because in the past, many people would ask for their stock certificate and have title to it, but now all the title is held by the dealers in client name. And there's been a lot of controversy over that in any public stocks where they would call for a meeting of shareholders and more people would show up than are listed as shareholders. Mm-hmm. The stock would be sold multiple times over.
Yeah, and what we found is they do keep some stock certificates in physical form, but it's like fractional reserve. So you have multiple people on the same stock certificate because they're keeping them in bulk. So they issue them in these big tranches of how many ever shares, say 100 or 1,000 shares, and then they'll list all the people that may have an interest in that. But like I said, it doesn't go to the investor first. It goes down through the chain of how these securities are bought. It's a really interesting subject that I think a lot of stock investors should look at. I think it's in a case where you're trying to prove ownership of something. For example, if the company goes bankrupt, well, first the bondholders are going to get paid typically, and then the stock owners anything left. But even if there's anything left, if you don't have that certificate in hand, it could be very difficult to get any of your money back. And I'm not sure a lot of stock investors are really understand that. Well,
particularly when you consider that if you have amount in a margin account, then the likelihood is that what you think are stocks on your statement are stocks that have been lent out by the broker to an ETF.
Yeah. Yes, very interesting.
But your account is nothing more than broker IOUs.
Exactly, and we know how that goes when there's any sort of financial issue. As soon as the money runs out, it seems like everybody's overextended themselves and may not have the money to pay out, and then you have these multiple claims, on the same asset.
Okay.
Yeah. Well,
Exactly.
this has been a very interesting conversation, Nick. I've appreciated. I think this is a great article, The Illusion of Owning Gold, and I think specifically talking about the ETF vehicles and the risks with those from a title perspective, and just being able to redeem that for gold, which you can't, or for silver, which you can't, I think really highlights the risk there. So it's interesting. So I guess the lesson learned, if you're going to buy gold and silver, get it physical or get it with a reputable firm, such as yours, and of course there are many others as well, that provide allocated storage and provide, title to that, verifiable, auditable title to that, so that, you can get to those precious metals when you need them.
That's right.
Well, Nick, go ahead.
That's the big difference when we structured our bullion bars program, and I'm an investor in that myself, so I wanted to make sure that it was done right.
Well, Nick, thank you so much for the call. I appreciate your time. We will get this posted out to our followers and our investors, and it was great information. I really do appreciate you taking the time.
Okay, great talking to you, Robert.
Okay.